All right, we are picking up from where we left off in class problems. We're doing exercise 9-18 here. And we're supposed to prepare the entries to record their purchase of bonds on January the 1st, 2015. The recognition of interest income and interest received on the December 31st year-end date, and the fair value adjustment required at December 31st, the year-end date. And then part B, prepare all the entries required for 2016, including recognition of the impairment in value. So we're talking about impairment in this question, as it says up here, impairment of fair value through net income investment and subsequent recovery in value. And then part C is recognizing the recovery of the impairment. And then part D, discussion, identify the impairment loss model applied in this situation. And if they had accounted for this investment at amortized cost, identify and briefly describe the impairment model the company would have used under IFRS 9 and under ASPE. So that's the information that we need as to what we're going to do. The information in the question is listed here, so I would recommend that you take a screenshot and keep this, or take a look at the exercise 9-18 in your own read, study, and practice in Wiley+. So let me move it out of our way. Okay, there we go. And part A, prepare the entries to record the relevant information. So the purchase of the bonds, the recognition of interest on December 31st, and the fair value adjustment at December 31st as well. So let's quickly get started here then. The January 1st transaction, we paid $322,744 for some bonds, and they have a maturity value of $300,000. So we actually have a difference between the coupon rate and the market rate, the yield to maturity on these bonds. And so if we use our standard terminology for our financial calculator, we can actually calculate the relevant information, so the relevant yield. It says the bonds provide the bondholders with a 10% yield, so okay, so I guess we don't actually need to do the calculation, but let's do it anyway because it's kind of fun. So we need to put in minus 322,744.44. That's the present value. The payment, it's a 12% bond, so we've got $300,000, so 0.12, whoops, I guess we need a plus sign here, or equal sign, 0.12 times 300,000, and they pay interest annually. It says they pay interest each December 31st. So annual payment of interest, $36,000, and then of course we're going to get the 300 grand back at the end. And let's do a quick format here for these columns because they're not giving us the information we want with the commas and all. The bonds are dated January 1st, 2015, so they're brand new, shiny new bonds, and they mature on January 1st, 2021, which is 6 years. So if we were to calculate the I per Y on our financial calculators, we could actually do that in Excel as well. And so in Excel, we're looking at the yield. And okay, let's see what we can do. The settlement is security settlement date expressed in, okay, we don't want that, that's the wrong formula. Let's try a different one. And we go like this, and yield, maturity, how does that sound? T-bill yield, okay, I'm taking too long to do this. Let's just do it in the calculator, because the calculator is much more helpful. 322 744.44. Okay, let's just escape from there. And apparently I need a couple more digits here. There we go. So that is the amount that we're going to put in as present value. Make it negative. Then we'll put in 36,000. Whoops, 36,000 is the payment. 300,000 is the future value for 6 years. And compute I for y, and works out to be 10.24664. Okay, that's something that's a little bit off there. 6, 7, 8, 9, 10, 11, that is 6 years. It's not exactly a 10% yield, so if we actually do the calculation, it's 10.25% is the amount of the yield. I guess that's why the amortization table in the solution doesn't actually get to all the way to the end. Well, I'll tell you what, I'm going to do the calculation with the 10.25% yield, and we can actually see the amortization table all the way to the end then. So let's go date, and we put 1 January in 2015, and then we'll do annually after that. And we'll grab these two, and we can grab the little corner box thingy here and drag it down all the way to 21. There we go. So that's 1, 2, 3, 4, 5, 6, 7 years. Okay. I suppose that means that this number is wrong. So let's try that. Always good to do a timeline, even if you're an old guy like me. So let's make n 7 and then recompute the I per y. That's not better. That's 10.42. Alright, so this is your 1, whoops. Oh boy. 1 and 2 and 3 and 4 and 5 and 6 and 7. Okay, so it is a 7-year bond. And it looks like we have all the right numbers there. When I do that calculation, we'll get 10.421 as our rate. Alright, well anyway, we'll still continue from that. So we're going to put in principal over here, just like the principal of a school. And here we have the coupon payment. Let's just say payment. And this is the interest. Actually, we should do the interest first. And then we have the payment. And then we have the reduction. And then we have the principal. So the principal starts at 322, 744.44. And then the interest is going to be 0.1042107 times that number. And then the payment is going to be 36,000 every period. So we get one of those every period. We can just drag that down. Okay. Doesn't want me to drag it down. There we go. Having dragged. So then the reduction is going to be the reduction in principal. So we're working our way towards 300,000 in this case. So this is a premium bond. They want 10.42% in the market, and we're paying them 12%. So they're pretty happy to pay us extra for that. So here we're going to take the interest portion minus the payment portion, and that gives us a reduction of 2367. So here we're going to take that number and add that number, since we have a negative value there, and then we're going to just multiply that all the way down. And then we're going to multiply this all the way down. Double click on the little thingy. And of course we can see that it isn't getting all filled in. But there we go. And here we have the perfect ending principal amount, which is kind of what we wanted to have. So, except for the fact that I just reread the question. It says that they mature on January the 1st, 2021. So they actually meant mature here. So then the number goes back to 6, and we end up with 10.2.25 when we calculate that number. So let's just do a quick little adjustment here. And double click. Alright, so we can see that the amortization table doesn't quite work out exactly. So let's see if we can get a little more detail. So once again, I'm going to put 6 in my n, compute the I per y, 10.24664. Alright, and so then we're going to I think I know what we can do. We can just go up here. We'll pick that, and we'll make it permanent with an F4. If you just click on F4, it uses that same exact reference. So we've got an absolute column reference and absolute row reference. So we can hit that, and then if we just copy that all the way down, there we go. Oh, that is nice to see, isn't it? 300,000 at the end is the principal that we're supposed to have, and so this means that our 10.25%, 10.24664% is the actual yield. So even though the question says the bond provided the bondholders with a 10% yield, they didn't give us the amortization table all the way to the end, and so their numbers are slightly different. So I'll let you take a look at the solution for that, but let's do the calculations on the basis of the actual interest rate, the actual yield to maturity from the bond as we've calculated here. Alright, so after all of that, the first entry we're going to make on January the 1st, when we purchase the bond, is 1-Jan, is fair value through net income investments. And we paid cash for them, and the amount of cash we paid is $322,744.44. And we need, apparently we're working with pennies this time, so let's add a couple more digits. There we go. Okay, so this one is just going to be the same as that one, so we can just copy that. Stop. Don't do anything like that. Control copy. It doesn't like that for some reason. Maybe it's because I'm not hitting the right button. So let's just go over here. We go equals that. And there we go. So the amount of cash we paid on January the 1st was $322,744.44. And the question says that we're supposed to record these entries based on the assumption up here. So the question says that Mahmoud applies IFRS 9. It accounts for the bonds at fair value through net income, and so that's why they're fair value through net income investments. And it reports interest income separately from other investment gains and losses. So we're going to call interest income, as opposed to investment gains and losses. And then it tells us that it applies IFRS 9 with the fair value through net income. So that's why fair value through net income investments and cash. Now on December 31st, we have earned a little interest to get a cash payment. And so we're going to assume we actually received the payment, because otherwise we'd set it up as interest receivable. But we actually received the payment of $36,000. And that represents interest income. Partially. It represents interest income of that amount right there. And the reason that is the interest income amount is because that is the interest at the actual effective interest of 10.25%. I knew you were all hoping that we would have an effective interest question somewhere in here. So here it is. And of course that means that the fair value through net income investments are moving closer to their face value. So their face value is 300,000, not 322, so we're going to reduce that by this amount over here. It's essentially the balancing figure. So if we highlight both of those and look way down here at the bottom of the screen, you can see that the sum of those two is not the number I'm looking for, because that's negative. So let's fix that. Okay, so we go minus and 8. Now if we highlight those two, it should add up to exactly 36,000, and we see that it does down here. This is a convenient little space at the bottom of Excel. Kind of helps us out to see a few interesting things. Average, count, and sum. Okay, so that's the 31st of December. And then it says we're supposed to recognize the interest income and interest received on December 31st, so that's that one. And then it says the fair value adjustment required at December 31st, 2015. So this is, let's put a 15 over here. And let's move the A out of our way and put a 15 here. Okay, that'll work. So that's the fair value adjustment required at that time. At December 31st, 2015, Mahmoud's year end, the bonds had a fair value of 320,700. And so that, of course, is a difference from the initial amount. So we've recognized the change in fair value through net income investments in this transaction for the payment of cash. But in this transaction, we need to recognize the fact that the fair value has changed, and it is not actually 322 minus 2929, so it's not actually 319,815 as we see over here. It's actually 320,700, which is good for us because it went up in value a little bit, right? So we're going to increase the fair value through net income investments. And we'll put that into, we can call it investment gain or loss. They call it unrealized gain or loss. And the amount of the gain or loss here is going to be the difference between the, well, we need the number to be 320,000 after we're all done the calculations, and we're going to subtract that number minus that number there. And so the amount of the increase in value is $885.10. It's 327,700 minus this 319,815 we've calculated over here, way on the right side of the screen. And of course the amount of the gain or loss, the gain in this case, $885.10. Okay, so that adjusts the value now to be 320,700. So that's the answer for part A. And then it says in part B, which is 2016, we're supposed to prepare all entries required for 2016. And so let's just look at what happened during 2016. During 2016, the economic outlook related to the bond issuer's primary business took a major downturn, so the debt was downgraded. By the end of 2016, the bonds were priced at 85.5, and at December 31st, 2017, they were selling in the market at 87. Conditions reversed in 2018, and the outlook for variation significantly improved, leaving their bonds with a fair value of 99.5, so 99.5% of face value at December 31st, 2018. And so in part B, we're going to prepare the entries for 2016 and 2017. Then in part C, we're going to recognize the recovery in 2018, back up to a value of 99.5 of the face value. And then we're going to have a little bit of a discussion in part D. So Part A is all good. December 31st, the first thing that happens is we receive some cash. The amount of cash we receive is the $36,000. It's always good to receive cash. And then fair value through net income investments is adjusted for the amount of the interest income there. And so the interest income is presumably from the amortization table. So let's just do that. Credit interest income. And so that is just simply going to be the second year. And of course the difference is going to be adjusted to fair value through net income. Basically the accretion of the discount, if we use that terminology. And so that is just going to be this adjustment right here. And of course that's not quite the right number, because that's the interest income we're earning on the bond based on the initial yield, but it's not the is not actually adjusting the investment to the correct amount, because the correct amount is 85.5. So we need the value of the excuse me, the fair value through net income investments. And once again, of course, I have the wrong sign here. You're not supposed to have negative signs on your debits and credits, so your journal entries never have a negative sign. Once again, we can just check quickly. 36,000, yay. But the other thing that happened here is that the value of the bond went down to recognize the unrealized loss in this case in value. So we have an unrealized loss. And since we categorized them all together, we'll just leave it there. And the fair value through net income investments. What we want here is the result that well, let's just type it in here. We want it to be to record fair value at 85.5, which is 85.5. So 0.855 times 300,000 face value. 256,500. So that's the number that should be in place after we're done all of these adjustments. So in order to accomplish that, we basically take all of the pieces that we've already adjusted for, and the last adjustment, this adjustment right here, was the adjustment to change the value of the fair value through net income investments to 320,700, but then we took off this change. So if we're doing the calculation, let's put it here. We have the value now, which is 0.855 times 300,000 minus the value that we've got so far, which is 320,700 was the last change in value, so that's the value at the end of December 31st here. And then we need to subtract the change which we've already recognized, that number. And that gives us the net change. Ooh, a fairly substantial one. And of course that's that's going to be negative when you put brackets around it, because we've got this other parenthetic expression here. So 60,970.28 is the amount, using our assumption of 10.24, etc. percent income, interest income. So that does that one, and then we do it again in 2017. In 2017, the value goes up again. 31-December. We debit and we credit some information. So once again, we get cash. We have interest income. Alright, I'm getting lazy. Let's go there. And then we'll just drag that down on here. There we go. So the cash is equal to that payment of cash, and the interest income is equal to that payment of interest income, and the fair value through net income gets adjusted by that amount. Okay, and of course, once again, I forgot to put the negative sign up. There we go. So that adjusts for the collection of interest through coupon payment, but it doesn't adjust for the fair value. So if we were to just copy all of this and put it down here. Alright, that's of course the wrong number. We're going to have to adjust for that. But the last value we had was 256,500. And so in this expression we have 256,500. 256,000 was the last value, so that was the value that we had at the end of December 31st, 2016. So that value is shown right here. And then we subtract the fair value through net income adjustments, which we did as a result of the amortization table, which is this one right here. And of course we have to adjust now for the fact that the value has gone to 0.87. So that is an increase in value. So we get rid of the little negative sign here. And of course that means that these are going to be backwards. So let's cut that out of there. And let's cut that out of there. And in this case, the value went up. So let me change my little note down here. So the value is now 87 instead of 85.5. And so of course the difference is going to be 0.87 times 300,000 is 261,000 even. So 261,000 is our new value. And if we do all of the adjustments that we need, we actually are reversing the unrealized gain or loss that we put in up here by a little bit. So we're going to put in unrealized gains and loss. So let's just copy that and pop it in here. There we go. Okay, so that takes us all the way to 2017. Now in 2018, good things are happening in the market, and variations, credit rating is getting better. So we still get our coupon payment, which is good. So let's just grab all of this and we'll copy it down here a bit. Okay, of course that means that all of my links are going to be wrong, and yes indeed they are. So let's try to keep everything in here. Again, cash, the cash we get is this bit of cash from 2018, and the interest income we get is this bit of interest income from 2018, and the fair value in net income is hey, there we go. Let's remember the negative is this little change right here. So that gets us all of that. And in this case, we're going to record the fair value back up to 99.5, which is almost all of it. So 300,000 times 0.995 gives us 298,500. Nice round number. So that's the new value. So that's the value we need to adjust it for. And since it's going up just like this one, we actually have them in the right order here. But now we're going to adjust our little parenthetical expression. This is going to be 0.995. And so that's the value that it should have after all of our adjustments. The last adjustment we did adjusted it to a value of 261,000. And so the 261,000 minus the 39.25 gives us our new value of $41,000. So our adjustment there is $41,000, and that's pretty consistent with the assumption of a 10% rate of return. So that was looking pretty good. The fair value through net income investment value goes up to 41,002. By 41,425.50, and that takes us all the way back to the end of part C. So I forgot to put in the C here. This is part C of the question, and we're good. So that's all the calculations we need to do, but we do have one additional question. It says identify the impairment loss model applied in this situation. And so this is what we call a fair value impairment model, and the fair value impairment model reduces the value to the fair value at each balance sheet date, and it can be remeasured up to the original cost of the bond, which was $322,744. And so this entry has brought it back up to a value of $298,500, which is less than what we paid for it. It was a premium bond when we bought it. It's still a slight discount bond because it's still slightly less than the face value of $300,000. So the question also says, if they had accounted for this investment at amortized cost, identify and briefly describe the impairment model the company would have used if they applied IFRS 9 or if they applied the ASPE standards. So under amortized cost, they would have used an incurred loss model under ASPE, and so you can review my notes from the recorded video lecture to determine what that exactly is. Basically, it's the impairment loss is measured and recognized when the rating change and the debt downgrade resulted in the bonds being priced at a significantly lower amount. So that's probably evidence, objective enough evidence, that the expected future cash flows have been significantly reduced. Under IFRS 9, they would record an impairment loss at the first reporting date and then assess whether the credit risk had been increased significantly. And of course, we're talking about a debt downgrade here, so the default risk would have been decreased. They need to make the assessment, though, as to whether the credit risk on the investment has increased significantly since the downgrade in the investment category. And if they say that the default risk has not significantly increased from their perspective, then it would consider the next 12 months and the expected credit losses in the next 12 months. If they determine that the default risk has significantly increased, then the company would look at the lifetime expected credit loss, and so they would calculate the present value of all of the future cash flow that they actually expect to get over the life of the instrument. And then you would calculate the loss as the difference between the carrying amount of the present value and adjust it in the same way that we adjusted it here. And the discount rate would still be the historic discount rate, so it would be, in our case, 10.25%, in the solution's case, 10%. And then, of course, when the investment value subsequently increases, the impairment losses might be reversed up to the value of the initial cost. So, the calculation that we actually did here, I don't know if I can get it all back on screen, but that calculation that we actually did would be consistent with IFRS 9. This is there. And because we actually have adjusted the fair value through net income investments. Now, the fact that we're using the current fair value would indicate that we're using the assumption that the default risk has significantly increased, because we're actually adjusting for the present value of all of the future cash flows in that value. So the value on the market for the bond is the present value of all the future cash flows. So when we record the value at, say, 85.5, we're recognizing the fact that the market has changed the value of the bond to reflect all of those future cash flows. And so we're essentially using the fair value impairment model. And that's all there is to Chapter 9, Exercise 18. We're not quite done, though. We have one more question. We have question number 22 that we need to consider. And question number 22 is next on our agenda. So, question number 22. Is shown here. And so, the question asks us to prepare journal entries for 2016 and 2017. A lot of journal entries in this intermediate financial accounting course, assuming that they cannot exercise significant influence over Gregson, in which case we actually use the fair value through other comprehensive income in the same way as we've done in the previous few examples. Well, we actually have the option between fair value through net income, which we've used in some examples, and fair value through other comprehensive income, which we've used in a couple of the examples. And it tells us in the first part of the instructions that the investment is accounted for using the fair value through other comprehensive income model. They don't have significant influence, so they don't actually record the change in the value using the equity method. We're not going to spend a lot of time on the equity method in this course because we have a whole other course, Business 401, where we talk about that in quite a bit of detail, so we're going to leave that discussion until then. But the fair value through other comprehensive income model is appropriate in the case where we don't have significant influence over the associate company. And then part B says prepare the journal entries assuming that they can exercise significant influence, in which case Harnish is an associate company with Gregson, and Gregson is the associate company for which we're going to calculate the equity method. And that gets a little complicated, but it's actually sort of beyond the scope of what we want to do in this course. So I'll show you the calculations, but it's not something that you would be expected to be responsible for on the exam in this course. So you can ignore the equity method, except to be aware of the fact that it applies in this situation. And then part C says what amount is reported for the investment under the assumptions in A and B, and where is the investment reported on the statement. The investment is going to be recorded as an investment in long-term assets, presumably, for the equity method, and it could be recorded as a current asset in the fair value through the comprehensive income method, depending on whether it was being held for trading or whether expected to be held long-term. So, in both cases, you would expect it to be in non-current assets because there's nothing actually in the question that indicates that we're planning to earn short-term trading profits. So it's not actually just a quick turnaround; it's a long-term investment. So if we had expected it to be held for trading, we would have accounted for it with the fair value through net income approach, and it would have been recorded in current assets in that case. And then what amount is reported on their statement of comprehensive income in 2017 in each of these methods. The equity method would record it as income, as net income, as income from equity, whereas the fair value through other comprehensive income would record it as below the line of net income, and it would be part of other comprehensive income in the income statement in that case. And yeah, so we'll do a quick little statement of comprehensive income summarized, or a partial statement of comprehensive income to show that. So once again, take a screenshot if you want, or look at your own Wiley Plus site, and we'll get on with this. So since we're doing lots of journal entries, we'll just we'll pick up back somewhere here where we have some journal entries. And let's just copy that. I don't know, let's copy the tab, which is what we want to do, and move it to the end, and then we'll change its name. You don't need to be watching all of this while I do that. Alright, there. First question, prepare the journal entries for Harnish assuming they cannot exercise significant influence. The investment is accounted for using the fair value through the comprehensive income. So, it says they acquired 25% of the outstanding common shares of Gregson on December 31st, 2016. So, 16 31-December. They bought some stuff, so debit some stuff, and that stuff is called fair value through their comprehensive income investments, or yeah. So in part A, we're using the fair value through other comprehensive income as our way of recording these investments, and it tells us that we paid $1,250,000 for them, which is a lot of cash, and it's equal to 25% of Gregson's carrying amount, which really doesn't apply to us in this part, but it does have an impact on the next part. We'll see that in 401. The carrying amount is an important part of the determination of goodwill, and so we don't have goodwill in this situation. We don't have to worry about it. Of course, that costs us cash, so the cash is going out the door. There's our entry. Okay, good. So that was 2016, the purchase, and it says they declared and paid a 75-cent per share dividend on June the 15th. So we're going to have to record the fact that we got that. So this is June the 15th, presumably 2017. And we got some cash. Cash is always good to get. And the amount of the cash we got is 0.75 cents per share. And they bought 25% of the outstanding common shares. And so we bought 62,500 shares. So 62,500 times 0.75 each gives us cash of 46,875. And we're going to record dividend revenue, which is actually realized, so we're going to record it as income. And then at the end of the year, they paid another dividend on the 15th of December, which is nice of them. So well, it's the same entry, so let's just go like that and copy. Saves us lots of time if we actually hit the right buttons. So the same dividend amount in both periods. And then we also have information about the fair value. It says the fair value of Gregson shares was $21 per share at December 31st, 2017. And so on the 31st of December, we either change the value, and probably would be a good idea for us to figure out how much the value is at. So let's just do the calculation here. It's $21 per share times 62,500 shares. That works out to 1,312,500, which is a little bit more than we paid for it, right? So 1,250 was what we paid for it, which means we have an unrealized gain. So the fair value through other comprehensive income investments I should know better than the typing is going to be increased by the difference between that and the 1250 that we started with. Okay, and that's that. So we made 62,500, but we haven't actually received it yet. Oh, I'm missing a few credits here. Just a second. There we go. Okay, accountants are supposed to get attention to detail and all that kind of thing, so we better make sure that's right. And of course, it goes through other comprehensive income, unrealized gain or loss. Through other comprehensive income. All right, we need a little bit more room there. So let's give ourselves a little bit more room. First of all, hit enter. And we can just grab the side there. That gives us a little bit more room. Okay, so of course that's the same amount. Let's see. Whoops, what did I do? I want to go equal that same amount. And that's just the difference between the current fair value of $21 per share times 62,500 minus the 1.25 million we paid for these shares in the first place. And that answers the first part of the question quite nicely. That's part A. Part B. Part B, we are using the equity method because the assumption is that the parent company, Harnish, can exercise significant influence over their associate, Gregson. And so here we actually have to use a little bit of techniques which you will get much more familiar with in 401 when we get there. But the journal entry, the first couple of journal entries, all of these, would be essentially the same. No, they wouldn't be, because that's the cost method. Sorry, let me back up again. The first entry would be the same, except for the fact that it's not a fair value through other comprehensive income investment. Just put that there. It would be a significant influence investment, an investment in an associate. Of course, the amount of cash paid is still the same, so we're just doing the accounting. And then, at the end of each year, we need to determine our share of the earnings of the investment, or the earnings from the investment in the associate. We're actually receiving some cash. But at the year end, we need to record an additional entry to recognize the fact that we have changed the value because we've earned income. So the associate earned income of $520,000 during the year, and that's ours. We do need to record these dividends because we actually received the cash. So we can record those. But it's not dividend revenue because we're using, instead of using the fair value through other comprehensive income approach, we're using the equity approach. So when we receive dividend revenue, we actually reduce the investment in our associate for that difference. IATE, thank you. Pop it down there so I don't have to type it again. Alright, so then on the 31st of December, we still have to adjust for the fact that we have a value change there. But in this case, the value change is through our share of the earnings of the subsidiary company. So we actually changed the investment in the associate. I don't know why I just didn't hit Control Paste there, but and it is calculated as $520,000. That's the entire earnings of the company, and we own 25%. So that's our share. The investment goes up by $130,000, and then of course we record the investment income or loss at the same amount. So essentially, the company earned $130,000 on our behalf, and then they paid us $93,000 in dividends. So the net impact on our investment is the net of all of those things. So part C of the question asks us, let's go up here so we can see all of the information still. Part C asks us what would happen on the statement of financial position, so the balance sheet. So this is under Part A rules, and this is under Part B rules. And the statement of financial position, the investment account. Okay, let's make this a little smaller. And we can make this a little smaller too. Alright, so now we've got a little more room to work. And then if you just double click on the right hand border, it automatically adjusts for it, which is kind of cool. Under the fair value method, FV-OCI, and the equity method, equipped, okay. The value of the investment would be shown as the total of this number plus this number, because they're both debits. That would be the value shown on the long-term assets, and this of course would be non-current assets. investment. And so that's the value under fair value through other comprehensive income. And then under equity, we're going to start with the 1,250,000, and we're going to subtract the 2 dividends, and we're going to add the share of investment income from our sub, and that is 1,286,250. So once again, that value is, well, let's double click on it and you can see the color coding. We start with that one minus, so I guess we probably should have referred to the other side of the equation here, but it's the right number anyway. So we're deducting the 2 dividends and adding the investment in the associate. All right, so that's part C. Now D asks us to do one more thing. It asks us to tell you about the it asks you to tell us about the amount that's reported in the statement of comprehensive income. And so we have dividend revenue. Alright, we need a little more width. Okay, so dividend revenue under the fair value through other comprehensive income is going to be the total of that one plus that one. And of course there isn't any. Oops. Can't just put a dash in. And then, so that was the fair value through other comprehensive income. And then we have investment income, which is what we have down here for the equity method. So that's, what did I do? Oh, click the wrong button. Is that amount? And that gives us our net income, partial net income. So we're just going to add that up. So we have the sum here. There we go. Let's put in our upper border. There we go. And then if we click again, just drag that over. So that's the amount that's in net income. And of course we have the other comprehensive income, unrealized other comprehensive income. And of course that's nothing for this one, but it is something for this one. It's equal to this unrealized gain or loss. Hold it. Huh, I'm doing it exactly backwards. Forget what I just said. This is the amount of the unrealized gain or loss. Equals this amount. There we go. And then we have our comprehensive income. Let's make it partial again. Well, we don't have a lot of room here, so let's go space, income. There we go. And so here we're going to put the accountants. Whoops! No, don't do that. And put in the upper border in both lines. So we have to start here. And then we're going to put the bottom border, and of course it's right at the very bottom of the income statement, so we've got a double border there. Okay, now we need to do a little, oops, didn't actually like. Okay, skip that, let's just put it in. Okay, so now we've got the formatting looking pretty good. So this is just going to be the sum of those two numbers. Didn't quite make it all the way to the top, so let's go all the way up to the top. And then we can just grab that and copy it over here. We can just grab that and copy it over here. So our comprehensive income is increased by 156,250 as a result of this investment under the fair value through other comprehensive income, and it's only 130,000 under the equity method, and the $130,000 represents our share of the income of the associate, and of course they paid us a couple of dividends, which reduces the amount of the investment account, so that's recorded in the balance sheet effect up here. And you can see that if we had the ability to influence the timing of dividends, which we do as the assumption under significant influence, that we could actually make ourselves look better off, because if we use the fair value through the comprehensive income method and recorded the dividends as we received them, we would have actually recorded an investment increase higher than the investment shown under the equity method, and the dividend revenue would have been included in net income. Some of it would have been unrealized gains and losses, but the effect on the comprehensive income and our income statement would have been an increase of $26,250. Now, largely that's because of the fair value, the gain in the value of the company, and so that value gain hasn't been recorded here, but it's implicitly recognizing the fact that we've actually earned income of $130,000, or the company has earned $130,000 on our behalf. So that is the last question in the exercises for Chapter 9, and so I'll post these on Moodle for your enjoyment. Thanks for listening. Goodbye.